As a team of consultants, we were hired by Draxis to take a look at some current crises that they are facing. And my colleagues, Sash, Jason, and Ellie, and myself, Damien, we will brief you on our analysis of the issues. So the first issue is the currency appreciation problem that Draxis is facing. The situation is such that they just received a new contract worth $120 million US over 20 years, starting in 2009. The problem is because of the current volatility and the strength of the Canadian dollars, they want to protect their profit margin from the currency volatility. So they want to hedge against the Canadian dollar appreciation. Needless to say, when you hedge against the Canadian dollar appreciation, you will lose any benefit if the Canadian dollars actually depreciate. But that's something to be accepted if you want to protect your profit margins, if you want to lock it in. So the situation is that our cost incurred is in Canadian dollars, and the revenue is in US dollars. So potentially, we have two alternatives. We can hedge only the cost. Since the amount will be lesser, the cost of hedging will be cheaper. And we will, however, this will not protect the profit margins due to the revenue fluctuation. Or we can hedge the revenue. This will be more expensive. However, this will protect the profit margins since both the cost and revenue will be in Canadian dollars. So before I go any further, there are two caveats. First, we will always face a profit repatriation risk since the company is listed both on the TSX and the NASDAQ. So it doesn't matter what kind of hedging we do, the most we can do is protect the profits margin. We will not be able to protect the absolute dollar amount. It depends on whether we choose to hedge the revenue or we hedge the cost, and depends on whether the Canadian dollar appreciate or depreciate. And keep in mind that some investors probably already hedged their own portfolio, but this probably isn't the majority. So what they can do is they can buy a similar Canadian company and an American company. So if Canadian dollar appreciate, they will benefit from one, and if the US dollar appreciate, they will benefit from the other. But unlikely they will be able to find such similar companies considering the unique situation that Draxis find itself in. The short-term solution, we can look at futures. Futures is calculated based on a mark-to-market daily. As such, there will be less of a credit risk premium. It will be more standardized, more liquid, because it trades on the foreign exchange. However, futures tend to be for shorter-term hedges, typically up to 3 months. Longer term, they can look at forward contracts. Forward contracts are traded mainly over the counter, so you can customize the length. You can customize it up to the 10 years that we require. And forward contracts are settled at transaction date. As such, there will be a bigger credit risk premium. The cost will be more if you choose to use this method. Alternatively, another long-term hedge, we can look at currency swap. And my colleague, Ellie, will walk you through the analysis.
So to break you through the steps, so the idea is that Draxis is going to receive $6 million US from the customer. They're then going to pay the counterparty the $6 million US and receive in return the 6 million Canadian. Conversely, the counterparty is going to receive the 6 million annually, as well as pay out the 6 million US. Now, the cost typically for this were pretty much between 0 and 0.5%, and we determine the cost based on the ability to find a corporate counterparty that would actually want to go forward with this transaction versus having to find do the transaction on the financial markets, as well as the Draxis credit rating. To take you through the steps, some of our assumptions that we made, so we have revenues of 6 million. We assumed a margin on sales of 70% depending on the type of product that we're actually referring to. Cost then would be 4.2. Capital expenditure in the first capital expenditures would be 3.75% yearly. on top of the revenue, working capital of 22.75% of the first year, which we assume will be returned in the last year, and the annual cost of the swap of around 0.3%. With this, so we did an analysis based on revenue hedging as well as cost hedging, and you see the NPV with the swaps and without the swaps, and then we came to our cost of the swap, so that'd be $140,000 for the revenue hedging and $100,000 for the cost hedging.
Well, we've just faced one crisis, and we've hopefully proposed a good solution over 10 minutes. Hopefully we can be just as efficient for our second crisis. Now, the second crisis that we face is that Draxis is being stalked by a private equity firm who's made a takeover offer to them. Now, before we delve deep into this situation, first of all, I'd like to get into a quick summary of the Draxis strategy. The key takeaways from this slide that we'd like to communicate, first off, is Draxis' product market focus. So Draxis competes in three segments. They compete in sterile and non-sterile contract manufacturing, as well as radiopharmaceuticals. Now, in terms of what makes Draxis special, I'll have you take a look at the value proposition. They have expertise in sterile manufacturing. They're able to highly customize batch manufacturing for their clients. And finally, Draxis has excellent customer relations. Now, looking at the industry structure for contract manufacturers, there's a trend towards outsourcing amongst big pharma as well as some of the smaller virtual pharmas. Now, this is driving the big pharmas to sell off a lot of their manufacturing assets. And some of the key success factors for the contract manufacturers is really about scale and capacity utilization. So you need to keep your fixed costs down, and you need as much capacity utilization as you can. And there's likely to be more consolidation in this industry simply because of the key success factors. Now, what makes Draxis an attractive target for takeover? It's got strong, capable management. They're very, very skilled at navigating the regulatory process. They have some attractive assets. First off, sterile manufacturing. There's relatively few players in this area right now who can produce to the type of quality that Draxis can. Second, they have a strong generic product that's about to come on market in 2009, which may be attractive from a cash flow standpoint. And finally, there's zero debt on the balance sheet. Positive free cash flows, which would entice leveraged buyout firms. However, I think some of the variability in EBITDA might be a little bit risky for some buyout firms. Now, in terms of taking a look at the takeover defense strategy that we would propose for Draxis, there's 5 steps that we would propose. First step being delay tactics. So you want to give Draxis management enough time to analyze the takeover bid and analyze possible options as well as valuations. And some possible delay tactics include a shareholder rights plan, which Draxis already has on the books. Now, secondly, once we've done these delay tactics, we want to bring on an investment bank to help us with a valuation, compare what the bank gives us in terms of a fair price valuation to the current takeover bid by the PE firm. Third, what we want to do is we want to employ a PR firm. This is important in terms of communicating management's message to investors. Now, it's split roughly between 50% retail and 50% institutional, so the communication might need to be more nuanced in this case. Fourth, what we want to do is we want to bring in as many bidders and suitors into this process to try and drive up the price and maximize shareholder value. And then finally, we want to look at any other alternative besides bringing in other bidders. So that could include selling off assets piece by piece, or possibly reverse takeovers or going it alone. I'll turn it over to my colleague Saj, who will delve deeper into our defense strategy.
So basically, the first thing we want to do is delay. We want to make sure that our shareholders have enough time to be able to react to this situation. The company already currently has a shareholder rights plan, so that will give the company a little more time. Basically, it says that a bidder must suggest that a company has 60 days in order to accept the bid, as opposed to regular Canadian law. This will, in fact, allow shareholders a little bit more time. Other options, in case management is in a bind because of an operation problem or interim management for some reason, include Pac-Man, where they would buy back the firm that's buying them, or a scorched earth plan where they would do something really messy with their finances. Now, keep in mind, we're not actually recommending that management do these. These are simply bluffs or threats in order to avert and delay the hostile takeover. Some of these might not even survive in court, but we're just looking for delay tactics. Basically, the next thing we want to do is start our communication plan. We want to reach out to all our shareholders. We could do that, we could consider that with a PR firm that specializes in this. There are some of those firms out there. This particular stock has a large retail base, so that presents some particular nuances when we're trying to communicate with them. For example, we would have to reach them with mail communiques, get the PR firm to contact people through mass media, issues like that where we can target retail investors. On the other hand, we do also have large institutional shareholders. These include Gagnon, Mackenzie, and Natcan, who hold between 7 and 10% of the company's value each. So we would want to have a sit down with those particular shareholders, communicate what our plan is going forward in order to make sure that they're on board with what we're trying to do in terms of either delaying or soliciting other bids. So the other thing I'd like to look at now is going after other potential suitors. In the private equity is where the bid came from. However, private equity might not be able to realize any actual synergies. They would be more interested in being financial buyers probably, unless they're looking to aggregate a bunch of similar companies. For that reason, we might be able to actually get more of a higher bid from other CMOs. The CMOs who are looking to integrate horizontally, for example, take advantage of synergies that way, might be willing to pay a higher control premium. So we would be interested in communicating with other potential suitors, explaining them the situation, touting our benefits, going on the road to talk to them. Other possibilities include large pharmaceutical companies looking to vertically integrate, for example. There might also be synergies gained from that or other supply chain benefits.
So as you have heard, our recommendation regarding both the hedging strategy and the takeover offer. So the only words we have left is regarding, just a few words to close up the hedging issues. The reason why we did not approach the natural hedging strategy, which means have costs in US as well as revenue in US, because we're limited to using our Quebec facility, which is in Canada. And most of our supply cost is also in Canada because we buy the radioactive material and whatnot in Canada as well as other supplies. So other than that, we have concluded our analysis. So we would like to open the floor up for questions. Thank you.
I'd like to just ask you a specific question about the strategy in regard to the potential takeover. What steps would you recommend to the company that they take to position themselves to respond on a longer term basis as opposed to the steps you've suggested this afternoon, really focus on the private equity firm coming forward at this point in time? What does the company need to do to protect its value and its shareholders on a go-forward basis?
Sure. I think I can answer this one. I think one of the first things we need to do is try and define what the capital structure is we want for the firm. So right now the firm is 100% equity, and that makes it a little bit of a vulnerable target for private equity firms. So what we want to do is figure out what the optimum capital structure is for this firm. Now, in terms of looking at on the revenue side, we want to solidify our positions both within within sterile manufacturing, where we have clear advantages, as well as within radiopharmaceuticals, where we have strong products coming online. I think in Q3 you saw some weaknesses with the margin of some of the sterile manufacturing products. So we want to try and solidify our position there and bring those margins back up, and try and keep this company less of a target in the future. Thank you.
Also on the private equity company's approach, do you have a sense of Draxi's value now vis-a-vis its current trading value?
Sure. I think in terms of looking at, we did a rudimentary DCF last night, and we came out to a target price for, based on our assumptions of around 465. And I think the street has projections anywhere from 350 to about 725, if I'm not mistaken. Right now, the shares are trading at roughly 360, and we have roughly split half and half between buy and sell.
Second question, do you think there are any natural strategic alliances this company could make that could actually insulate itself from an unwanted takeover?
Sure, I can take this one. Basically, there's a few options for partnerships for this firm, as you talked about. For example, they could partner with peer groups and actually form a larger block that way by partnering with horizontal companies. But maybe a more effective strategy might be to partner with a larger company, maybe get some assurances from the larger company that they will not infringe, but at the same time, this partner allows the company to avoid getting another large player from taking them over, because that large player knows that it could ignite a bidding war, for example. So making partnerships with large companies like distributors or suppliers might help that.
And a final one from me at this point is, what do you think the reaction from customers would be? You talked about some of the stakeholders, but customers weren't really mentioned in your analysis.
Customers constitute a very important stakeholder in this business because relationship is everything. When you have a very high concentration in customer, you really don't want to lose any contract. And these contracts, the bidding process can take up to years. So relationship is everything. Reliability and customer service is everything. We have to reassure the customers that regardless of however the company is going forward, whether it be a horizontal merger with another CMO or whether it will be vertically integrated with another bigger conglomerate, the customer service and reliability should stay the same. And we will do everything in our power to make sure that if there is potential conflict of interest, assuming that another vertical player will take us over, there will be a Chinese wall. And also, we will make sure that we reassure them going forward until the end of the contract length, there will not be anything untoward in terms of business practices.
Just a follow-on question for me. There are the two different issues. They're quite different. Regarding the currency situation moving forward, do you see that as a strategic or a tactical issue for the company?
I believe as it is right now, the hedging in currency, when you do it financially, normally would not constitute a long-term strategic plan. Ideally, you would want to have natural hedges. You want to incur your costs where you generate revenue. That way, the only risk you're exposed to is repatriation risk when you take the profit back to in your own country for reporting purpose. And furthermore, financial risks incur a cost, and that cost can be significant. So if it is long-term, perhaps another solution would be more suitable. But because of the current situation where we only have one manufacturing plant, and we do not have any lead time to build up capacity in the US, this is the best we can do, and it's a tactical solution at this point.
What was your recommendation in the first round about the situation on the plant and your manufacturing capability? Did you recommend that they stay in Canada and manufacture out of Quebec, or?
So our plan was, at the beginning, we do have excess capacity, and we had basically broke down our plan between what we're going to do in the short term and what we're going to do in the long term. In the short term, we definitely, our first goal and agenda was to fill that capacity in Quebec. And in order to do that, we were looking to either expand and find partnerships in Europe or find other products and send more products to the US. In the long term, once we were reaching our capacity, we were looking towards either finding partnerships in Europe or actually going green grass in Europe, and that's something that we would have to evaluate in that time. But that was sort of a 5-year projected and a 5-year look. Definitely in the short term, we're looking to fill that capacity as a first priority.
And how would you deal in some of the strategies around the hedging with the revenue variability? I know these are long-term contracts, but you don't know for sure that you're going to be seeing the orders. And was your recommendation to do the swap? It wasn't quite clear to me what your recommendation was.
So the assumption for us when we perform the analysis is that this contract is written in stone. So the revenue variability for this particular contract should not vary from year to year. As such, we do recommend a swap, because with a swap, you can potentially find a natural counterparty who want to hedge the other way. In such a manner, your hedge could cost nothing. Most likely, you will probably have to deal with a financial market maker, but at least with currency swap, you can find someone who's willing to do it with you on a zero-cost basis. But you're correct in terms that we are assuming revenue remains, for this contract, remains constant. Otherwise, there will be risk if we sign the swap, the currency swap, and the revenue decrease.
Just looking at the issue of limited synergies and the possibility that you may have to split the company, you mentioned GE as a possible acquirer of the radiopharmaceuticals portion, I assume. How would you make the company attractive to GE if they already have a competing product, namely MyoView? And how would you make it attractive if the whole potential for growth in an unknown environment, i.e. a generic product that's not been tested in a very competitive U.S. market for cardiac radiopharmaceuticals, proved to be not as oriented growth as you might imagine. So how would you make the product attractive to a potential buyer without any sales booked so far?
I'll handle this question. So basically, the issue with MyoView is currently it is a competing product with Cardiolite. But the Cardiolite patent is set to expire next year. We have a product called Sestamibi that is equivalent to Cardiolite, which we will be able to start ramping up next year. We've already applied for the production with the FDA. And so we believe we can position this product to GE even as a distributor. MyoView is considered not as effective as Cardiolite, and since our product is the same as Cardiolite but a generic version, we believe GE might be interested in carrying our product, in fact, because the market for MyoView is set to drop when generics are able to enter the market that Cardiolite leads right now. So basically we see a lot of potential for partnering with GE, and GE will be able to gain distribution market share by carrying a product that is better than the MyoView product they currently gain, as we expect a lot of price drop for MyoView going forward.
Could you comment a little bit about your views in the second scenario around takeover defense, about the cash position on the company and what your thoughts are on that front?
Sure. In terms of looking at Q3 on the balance sheet, they had about roughly 26 million on the balance sheet and 0 debt. And our reading of it was that this might make it an interesting play for a leveraged buyout firm who was looking to take over the firm essentially with its own balance sheet and then lever up the company and reap the profit rewards from such a scenario. So that was one of the worries for us in terms of LBOs.
Is there something we should do as a board?
I think that is more of a strategic issue in terms of what you want to do with that cash going forward. Do you see strategic opportunities to invest in areas within the market, be it in our radiopharmaceuticals or in our contract manufacturing business. Barring that, if there aren't any sufficient opportunities, then we would look at possible ways of returning that cash to shareholders, either through a dividend or through a share buyback plan.
Is that something we should consider as part of the strategy, or?
Yeah, we actually this morning we had considered we had advised to go ahead with a share buyback. Given all the other CapEx opportunities, well, we thought that that would be possible.
And to the size of?
I think it was about 1 million shares at roughly $4 a piece, so 4 million cash. And then we had proposed other CapEx opportunities on top of that earlier this morning, which would have eaten up some of that cash. Obviously, you want to have a certain reserve for contingencies, but that was our plan this morning.
An addition to that is that in Canada, when you issue the normal course issue a bid, there's a limit of how much shares you can buy back. So even if we have a lot of cash on hand, there's so many shares that we can buy before we reach the limit. Thank you.
Do you have any thoughts on dividend policy at all for the company, or?
We did bat this one around. Should we do dividend policy or buyback? And one of the areas that concerned us is the variability in revenues in this industry. So once you declare the dividend policy, can you maintain it going forward? And we weren't as confident if that was possible, especially given the Q3 results recently. So we decided to go with the share buyback.
Would your consideration of that be any different now that you know that there's another forward contract for $120 million in addition to the one that was already on the table this morning?
I think with with less variability in revenue, certainly that would cause us to give greater weight maybe to a dividend policy. But I still think that we would like to have that cash on hand to make CapEx investments before we did go ahead with a regular dividend announcement.
And in looking at the response to the private equity firm, I'm trying to put a finer point on exactly what your recommendation is that the board should do right now. I mean, these guys are outside the door waiting for an answer.
Well, I guess we sort of couched what our recommendation was: maximize shareholder value. And if that means going it alone, then it means going it alone. And if that means selling off to rivals or bidders, then so be it. But our view was to look out for shareholders and address the concerns of our shareholders and maximize value.
So what should we tell the guys outside?
What's the offer? I mean, I guess we didn't have the numbers here, so it was tough to get a sense as to sort of what the premium was that they were offering. But I think in terms of discussing it with our teammates, we looked and thought that CMOs, it's consolidating, and this was an industry about scale, and I think these were the guys that were most ready to pay the largest premium for Draxis.
The CMOs?
Yeah. Another competing CMO.